Good morning and welcome to TOITOI Japan Market Radio for Tuesday, March 10, 2026. I'm your host coming to you from Tokyo. This show is designed for global investors tracking Japanese markets, covering equities, foreign exchange, rates, and the key developments that matter for your Japan exposure. Let's dive straight into today's market action.
Thanks for having me. We saw a broad-based rally across Japanese equities today. The Nikkei 225 closed at 54,248.391, up 2.882%. TOPIX gained 2.477%, finishing at 3847.0. The Mothers Index, which tracks smaller growth names, rose 2.716% to 2458.0. Even J REITs participated, climbing 0.814% to 1981.0. On the currency side, dollar-yen moved to 157.757, down 0.423%, so we saw modest yen strength. Gold in yen terms edged up 0.311% to 19,355.0, while crude oil took a significant hit, falling 6.11% to 88.98.
That's quite a strong session for Japanese equities. Let's talk about what's driving this rally. The headline making rounds globally is about relief sentiment lifting stocks while the dollar extends its losses. Can you walk us through what's happening here and why it matters for Japan specifically?
Absolutely. What we're seeing is a classic relief rally in global equities, supported by continued dollar weakness. The dollar's decline reflects a combination of factors. Markets are pricing in the possibility of softer U.S. monetary policy ahead. There's some easing of geopolitical tensions, and we're seeing a rotation out of dollar-denominated assets into risk assets more broadly. This creates a risk-on environment that's lifting equities across the board.
And for Japan, how should investors think about a weaker dollar in this context?
It's a double-edged sword. On one hand, a weaker dollar typically pressures Japanese exporters' earnings because their dollar revenues convert back to fewer yen, which hurts reported profits. On the other hand, sustained dollar weakness often signals either expectations of Fed rate cuts or improving risk appetite, both of which tend to support Japanese equities. The relief rally itself suggests better global growth sentiment, which benefits Japanese manufacturers and cyclical sectors with heavy export exposure. For equities, the Nikkei and TOPIX are clearly benefiting from the risk-on mood, even if export-heavy names face some headwinds from yen strength. Near term, the broad equity strength is dominating.
Staying with the yen theme, what are the implications for dollar-yen and Japanese government bonds?
For dollar-yen, the yen should continue to appreciate as the dollar weakens globally. This could put pressure on yen-carried trade funding and may attract some safe haven demand for the yen. We're already seeing that today with the modest move lower in dollar-yen to 157.757. On JGB yields, the picture is a bit more nuanced. In a pure risk-on environment, you'd expect yields to rise as investors move away from safe havens, but dollar weakness that reflects lower U.S. rate expectations could actually keep downward pressure on JGB yields. So we may see contained movement in Japanese yields for now.
That makes sense. Let's shift to another angle on today's rally. We're also hearing that traders are gauging efforts to calm energy markets, and that this helped lift the Nikkei today. What's the story there?
Right, this is an important development. Japan's Nikkei closed higher in part because market participants are assessing ongoing efforts to stabilize global energy markets. There's positive sentiment around developments aimed at easing energy price pressures. For Japan, this is critical because the country is heavily dependent on energy imports. Energy price stability directly impacts corporate profitability, especially for manufacturers in sectors like automotive, chemicals, and utilities. Lower energy costs also reduce the risk of persistent imported inflation, which would complicate the Bank of Japan's policy stance.
So this is more than just a near-term equity positive, it has broader implications for inflation and policy.
Exactly. For equities, the impact is clearly positive near term. Lower energy costs improve earnings outlooks for exporters and domestic-focused companies alike. Energy-sensitive sectors like trading companies, shipping, and utilities likely benefited most from today's rally. For the yen, stable energy markets can support carried trades and risk appetite, though it may reduce safe haven demand for the yen relative to riskier assets. And for JGB yields, this is supportive of the Bank of Japan's accommodative stance. Stable energy prices reduce stagflation fears and keep inflation expectations contained, making long-duration bonds attractive and allowing the BOJ to maintain its current policy bias.
The key question, I suppose, is whether this energy market stabilization can be sustained.
That's the critical variable. Japan's inflation trajectory and the timing of any BOJ policy normalization depend heavily on whether global energy stability holds. If energy prices remain contained, it gives the BOJ more room to stay patient. If they spike again, we could see a very different set of market dynamics.
And speaking of energy spikes, we need to address the geopolitical dimension here. There are reports that LNG prices have spiked sharply due to tensions involving Iran, and coal markets are showing some divergence, with quality coal rallying. This seems to cut against the stabilization story we just discussed.
Yes, this is the risk scenario we need to monitor closely. Geopolitical tensions involving Iran have triggered a sharp spike in LNG prices. At the same time, coal markets are bifurcating. Higher quality coal grades are rallying while lower quality grades lag. This reflects differentiation by investors as supply concerns mount. For Japan, this is particularly sensitive because Japan is one of the world's largest LNG importers. A sustained spike in LNG prices directly increases Japan's import costs and widens the trade deficit.
And given the yen's recent weakness, this adds another layer of pressure on import costs.
Precisely. The yen's depreciation already makes imports more expensive, and higher energy prices compound that effect. This has the potential to feed through to consumer price inflation, which complicates the inflation picture for the BOJ. The bifurcation in coal markets also suggests supply chain complexity. Japanese utilities and industrial players will likely face pressure to secure premium quality fuels at elevated prices, which adds to cost pressures.
What does this mean concretely for Japanese equities, the yen, and yields if these energy tensions persist?
For equities, particularly the Nikkei and TOPIX, we'd expect downward pressure. Energy-intensive sectors like utilities, industrials, and shipping would face margin compression as input costs rise, reducing corporate earnings. For the yen, higher energy import bills would widen the current account deficit, reducing demand for yen and potentially weakening the currency further. There's also the possibility that the BOJ maintains or even extends accommodation if inflation remains import-driven rather than demand-driven. And for JGB yields, energy-driven inflation expectations could push the long end of the curve higher, potentially testing the BOJ's yield curve control limits. The key risk is whether Iran-related tensions escalate further, which could trigger additional energy price volatility.
So we have this tension between the relief rally and risk on sentiment on one side, and energy market uncertainty on the other. How should global investors with Japan exposure be thinking about positioning right now?
It's about balancing near-term momentum against medium-term risks. The relief rally and dollar weakness are supportive for Japanese equities in the near term, and today's gains reflect that. But energy market volatility remains a significant wildcard. If LNG prices stay elevated or rise further, that's a headwind for corporate earnings and could pressure the yen. Investors should be watching energy developments closely, particularly any escalation in Middle East tensions. The BOJ's policy stance is also key. As long as energy-driven inflation remains externally sourced, the BOJ is likely to stay patient, but that calculus could shift if inflation expectations become unanchored.
On the policy side, are there any near-term catalysts or data points that investors should be tracking?
Yes, the usual suspects: BOJ policy meetings, inflation data, and wage growth figures as we move through the spring wage negotiations. Energy prices will be a key input into the CPI data, so any sustained moves in crude or LNG will show up in the numbers. Also, watch for any BOJ commentary on yield curve control and whether they signal any adjustments to their framework. The dollar-yen level is also important. If we see a sustained break below 155 or a move back above 160, that could trigger shifts in positioning.
Let's bring this back to today's session. If we step back and look at the big picture, what are the main themes global investors should take away from today's action in Japan?
3 key themes. First, Japanese equities are participating in a global relief rally driven by dollar weakness and improved risk sentiment, with the Nikkei up 2.882% and TOPIX up 2.477%. Second, energy market stabilization has provided near-term support, but geopolitical risks related to Iran and LNG supply remain a significant wildcard. Third, the yen's modest strength today reflects dollar weakness, but structural pressures from energy import costs could limit yen gains if tensions escalate. The interplay between risk sentiment, energy prices, and BOJ policy will be the key driver of Japanese markets in the weeks ahead.